Okay, so let's unpack this. We're taking a deep dive today into the mind of Charlie Munger.
Right.
For many people, he was just Warren Buffett's right-hand man.
Mm-hmm.
But the sources you've shared, they make it really clear he was, well, way more than that.
Oh, absolutely. An architect of Berkshire's success, really. A polymath, champion of what he called worldly wisdom.
And everyone knows about his famous idea, the latticework of mental models, right? Drawing big ideas from different fields.
Yeah, that's the famous part. But the sources we looked at suggest something even more fundamental. It wasn't just having a toolbox of models.
Okay.
There was this unifying principle behind how he actually used them, the operating system, if you like.
Okay, so the big question for this deep dive then is, what was that unifying principle? How did Munger manage to synthesize all this diverse information, spot patterns nobody else saw, and, make these consistently great long-term calls, often when everyone else was running the other way?
Well, the core idea from the source material, the thesis really, is that Munger's actual alpha, his edge, came from how he viewed the world, specifically business and markets.
Which was?
He saw them through the lens of complex adaptive systems.
Complex adaptive systems. Okay, that sounds a bit academic. Can you break that down for us?
Sure. Think about an ecosystem, or maybe a busy city, or even something like the internet.
Right. Constantly changing, lots of moving parts.
Exactly. They're not static, simple machines. They're made up of countless interacting agents, people, companies, emotions, ideas. And these interactions, they're dynamic. They're nonlinear. Tiny things can have huge, unpredictable effects.
Okay.
And you get these properties emerging from the whole system that you'd never guess just by looking at the individual pieces.
Got it. So it's about seeing the connections, the constant flux, how things influence each other in, unexpected ways.
Precisely. And Munger looked at markets, businesses, human psychology, not as these neat, predictable mechanisms, but as these messy, evolving systems. He was just incredibly good at seeing that dynamic interplay.
And spotting the knock-on effects.
Yes. Critically, identifying the second and third order consequences. The ripples spreading out. That's what linear thinkers miss, right? They stop at the first obvious effect.
Ah, okay. So the systems thinking, this dynamic view, that was the bedrock, the operating system. And the mental models from psychology, physics, history, whatever, those were like the apps, the tools running on that OS.
That's a great way to put it. The systems view dictates how you use the other models. It tells you, okay, which tool from my lattice work helps me understand this specific interaction? Or how do I combine insights from psychology and economics to grasp this nonlinear outcome? And crucially, what feedback loops or unintended consequences should I be watching out for within this system?
Can you give an example the sources mentioned?
Sure. His famous Lollapalooza effect, that's a perfect case. It's not just one psychological bias working in isolation. It's multiple factors, psychological, economic, social, all piling up, interacting, compounding in a nonlinear way within the system.
To create some extreme result.
Exactly, an extreme, often irrational outcome. And his deep dive into cognitive biases wasn't just about cataloging errors, it was about understanding these predictable inputs into the human part of the market system.
Which then creates predictable irrationality on a bigger scale.
That's it. It's an emergent property of the system. And focusing on those second, third order effects, that's literally just tracing how one action ripples through the interconnected system.
So the lattice work isn't just a bookshelf of ideas. It's more like a dynamic GPS for navigating this complex, shifting reality.
That's the core idea, understanding the forces driving the system.
Fascinating. Okay, you've set the stage really well. Let's dig into the architecture of this system. How was it built?
Right. To really get it, we need to look at the foundations. The sources point to three main pillars.
Pillar number one being his fundamental worldview. The lens he used, built on that systems perspective, right? His view on markets, risk, and us humans.
Correct. His view on markets, for example, was totally shaped by seeing them as these human systems. He didn't buy the efficient market hypothesis, not really.
No perfect information processing.
Far from it. He saw markets as constantly swayed by collective emotion, by psychological biases, these dynamic forces within the system, and that, naturally, leads to mispricings.
Which is where the opportunity lies.
Exactly. That famous quote, "We stay sane while others go crazy," it's not just about willpower. It's about recognizing market irrationality as an expected emergent property of a system driven by flawed human actors.
And that connects directly to his view on risk, which was so different from the standard finance definition.
Totally different. Things like market volatility, beta, metrics focus on short-term price wiggles within the system. He thought focusing on beta was just nuts. For Munger, true risk wasn't just the price bouncing around, it was a risk of permanent loss of capital. Or maybe just as bad, the risk of inadequate return over the long haul.
So it wasn't about the market's mood swings, but the actual health of the business.
Yes, the health and resilience of the business within the bigger economic system, and importantly, the risk embedded in your own decision-making process within that system. He even included things like reputational risk or the risk of getting involved with shady characters.
Because people are nodes in the system, too.
Right. Bad connections create risk. So this view completely shifts your focus. You stop trying to time the market's ups and downs, and you start focusing intensely on judging the fundamental strength of a business and the soundness of your own thinking inside this volatile system.
And underlying both of those was his, well, pretty stark view on human nature.
Very clear-eyed, yeah. He saw us humans as fundamentally prone to cognitive biases. Predictable glitches, you could say, in the human software running the system. He laid this all out in his famous Psychology of Human Misjudgment talk.
Which explains why he hammered on understanding biases, learning from mistakes, especially other people's mistakes, and inversion.
Invert. Always invert. Absolutely crucial. Don't just think about how to succeed. Spend just as much, maybe more time, thinking about how you could fail.
Trying to be consistently not stupid.
Rather than trying to be very intelligent, it's a defensive posture. It's about building defenses against the predictable errors we humans make when operating within any complex system.
Okay, so if you tie those three things together, the market as this irrational human system, risk being about permanent loss, and humans being predictably biased.
You get this really powerful self-reinforcing logic.
Right. Because people are biased, the market system becomes inefficient and irrational. That creates mispricings, opportunities. Volatility, that's just a symptom of the system's behavior.
Yeah.
The real danger, the real risk, is losing your money for good because you misjudged the business's place in the system. Or, more likely, you fell prey to your own biases or the crowd's madness within the system. So the best defense isn't some fancy formula, but this psychological and intellectual framework designed to help you avoid irrationality by understanding the system and your own weak spots.
It's a coherent view of how things interact, a feedback loop he saw clearly.
Okay, that makes sense. So that's the lens, the worldview.
Yeah.
What's the second pillar?
The second pillar flows directly from that worldview. They're his non-negotiable filters. These are the strict criteria he used, informed by his understanding of complex systems, designed specifically to navigate and reduce the risks he saw within those systems.
And these aren't just a simple checklist, right?
No, not at all. They form an integrated screening mechanism. It all works together.
And the absolute cornerstone, the one everyone knows, is durable competitive advantage, the economic moat.
Absolutely central. In a complex competitive system where things are always changing and rivals are always attacking, a moat is fundamental protection.
Like a real castle moat.
Exactly. It shields the business, its cash flows from competitors. Maybe it's a powerful brand, network effects, patents, regulatory hurdles, maybe just being the lowest cost producer. Identifying a durable moat is key to guarding against that permanent capital loss risk in a dynamic world.
And who defends the moat?
That brings us to the next filter. Management with talent and integrity. In any system, the quality of the agents running things is critical.
Right.
Finding leaders who are not just capable, but also trustworthy, who allocate capital wisely, that was non-negotiable for Munger. He explicitly avoided people with questionable character.
Seeing them as a systemic risk.
Absolutely. Untrustworthy managers can wreck even a great business with a wide moat. Assessing integrity is hard, he knew that, but it was vital. Good managers protect and widen the moat from threats within the system.
Which makes sense. You need good generals defending the castle. And that ties into the next one. An understandable business model, staying inside your circle of competence.
Crucial. In a world this complex, knowing what you don't know is maybe more important than what you do know.
Only invest in businesses you genuinely deeply understand. Buffett often echoes this Munger principle, right? Know your circle. Size isn't important, knowing the boundaries. Vital.
Because the big mistakes happen when you stray outside.
That's where the risk of permanent loss often comes from acting outside your competence, misjudging a complex system you haven't truly grasped.
Okay, and all this led to that really key evolution in their thinking. Invest in wonderful companies at a fair price.
Yes, This was a huge Munger influence, a direct consequence of seeing the long-term value potential locked inside a high-quality business system. They moved away from the old cigar-butt investing finding statistically cheap, but often flawed businesses.
So it's quality.
Towards high-quality businesses with those durable moats, even if it meant paying a higher but still reasonable price. His insight was that the market system, obsessed with the short term, often systematically undervalues long-term quality and durability.
So paying a fair price with a margin of safety. A buffer against unknowns in the system. That became the rational play. Not just chasing cheapness, which might hide serious systemic flaws.
And to really capture the benefit of those wonderful companies, you need the last filter: long-term perspective and patience.
The big money is not in the buying or the selling, but in the waiting. Munger's famous line says it all. It's about harnessing the power of compounding a fundamental nonlinear force within the financial system and resisting the urge, the bias, to constantly fiddle and trade.
The do something bias.
Exactly. In a system full of short-term noise and emotion, real value takes time to emerge and compound. Patience keeps you from getting whipsawed by the system's temporary fluctuations.
Okay, so these filters are really the practical tools derived from his worldview. They're the navigation system for that complex, imperfect world, designed mainly to dodge the big, unrecoverable errors driven by systemic irrationality.
They put the worldview into action. Precisely.
Okay. All right, worldview, filters.
Yeah.
What's the pillars? The engine, the source code you mentioned.
That's the intellectual lineage, the Latticework itself. This is crucial. Munger wasn't just a passive investor. He was an active, relentless, lifelong learner. He deliberately sought out big ideas from basically every important discipline.
He insisted on it, right?
Absolutely. You must know the big ideas and the big disciplines and use them routinely, all of them, not just a few. This wasn't a hobby. This was the core code for understanding complex systems.
And we already touched on psychology being maybe the most important one for him.
Definitely critical. Understanding cognitive biases was non-negotiable for figuring out the human agents within the system, both the market crowd and, just as importantly, himself. His psychology of human misjudgment is essentially a field guide to the predictable ways humans mess up, driving so much of the irrationality and emergent behavior he saw.
The Lollapalooza effect comes straight from that.
Directly, combining psychological principles to explain extreme systemic results.
But he didn't just stick to cytology. What else was in the Latticework?
Oh, all sorts. Biology and ecology gave him concepts like competitive destruction, how businesses, like species, compete, adapt, or die off within an environment, finding a stable market niche,
Physics.
ideas like critical mass, feedback loops, ways to think about momentum and self-reinforcing trends within systems.
And math wasn't about complex equations.
No, it was about fundamental concepts. Probability theory, decision trees, and especially the incredible nonlinear power of compounding, the eighth wonder of the world, he called it. These are basic mathematical tools for understanding the mechanics inside the system.
History, philosophy.
Vital for learning from past system failures and successes. Invert, always invert. That has roots in thinkers like Jacobi, the mathematician, but also in ancient Stoicism. Even engineering thinking provided the parallel for margin of safety.
Building in a buffer.
Building in slack against uncertainty, which is exactly what you need when dealing with complex systems where you know you can't predict everything perfectly.
So this whole worldly wisdom project, drawing from everywhere, how does that specifically help navigate complex systems? Why not just stick to finance?
Because real-world problems in markets, in business, in life, they don't respect academic boundaries. They're inherently messy, complex, involving interacting forces from psychology, economics, technology, politics, you name it.
The man with a hammer problem.
Exactly. If you only know finance, every problem looks like a nail you can hit with a valuation model.
Right.
The Latticework builds a much more robust, resilient framework. It helps you recognize patterns across different domains. It primes you to look for those second and third order effects, to spot potential Lollapalooza situations where multiple forces combine.
It leads to better judgment.
It leads to more resilient judgment, that ability to be consistently not stupid. It gives you multiple lenses, multiple angles to view the complex system you're trying to understand.
Okay, so we have the worldview lens, the filtering mechanism, and the intellectual fuel from the Latticework. The system sounds incredibly robust on paper, but how does it actually perform under pressure? You know, when markets go crazy, when the complexity feels overwhelming?
That is the acid test, isn't it? An investment approach has to work when things are falling apart, not just when things are calm. And Munger absolutely designed this framework with stress testing in mind.
He talked a lot about temperament being even more vital than raw intelligence in investing. Why was that so key for him?
Well, he saw it firsthand, right? So many really smart people, high IQs, who are just terrible investors because, as he put it, they've got terrible temperaments.
They couldn't handle the emotional swings.
Exactly. You need emotional control, patience, discipline. You need to handle losses without panicking and handle success without getting greedy or overconfident. In a volatile emotional system like the market, your own psychological state is a massive variable.
So how does his intellectual framework actually help create or support that necessary temperament? It seems like it does more than just say, be disciplined.
Oh, much more. It actively engineers it, in a way. Take understanding cognitive biases. That's not just about spotting flaws in other people. It's about recognizing those same tendencies, confirmation bias, loss aversion, FOMO, kicking in within yourself during stressful times.
So knowing the bias helps you counteract it in the moment.
It gives you a fighting chance. And the long-term focus, which comes from understanding compounding and focusing on business value, that naturally helps dampen the psychological sting of short-term market noise. Volatility feels less threatening when your time horizon is decades.
The framework itself provides psychological ballast against the storm.
That's a good way to put it. And think about his definition of risk permanent loss, not volatility. That completely reframes a market panic. When everyone else is freaking out because prices are collapsing, the Munger-trained mind sees the system generating a potential opportunity fueled by fear.
Be fearful when others are greedy.
That principle comes directly from this framework. Staying within your circle of competence also builds temperament. It gives you the conviction to act when prices seem crazy because you trust your deep understanding of that specific part of the system. And inversion is like a constant behavioral coach during stressful periods. Wait, don't just sell because everyone else is. What's the opposite of the stupid thing to do right now?
It's like the intellectual architecture creates a shield against the emotional contagion of the market and your own knee-jerk reactions.
Precisely. Market panics, manias, these are textbook examples of complex adaptive systems going haywire, driven by collective emotion and cascading biases. Munger's framework gives you the tools to see these events for what they are: predictable, systemic breakdowns. That understanding, combined with his view of risk and time horizon, allows for disciplined rationality. It's not about being emotionless, it's about having a structure that prevents emotion from causing catastrophic errors. It lets you stay sane while others go crazy.
Okay, let's ground this in a specific case. The sources highlight the investment in C's Candies back in '72 as a really pivotal example. A proof of concept almost. Berkshire paid $25 million. And it's thrown off, over $2 billion since?
C's was absolutely crucial. It really cemented that shift Munger pushed for prioritizing quality businesses, even at a higher price, over just statistically cheap ones. And if you look at C's through the lens of his system, it's a perfect fit.
How so?
Well, the Worldview allowed them to see value beyond the simple financials. They recognized the power of the brand, that deep psychological connection. Customers had an emotional moat almost within the culture, which gave it incredible pricing power.
And the filters.
Checked all the boxes.
Yeah.
A massive economic moat. That brand loyalty meant they could raise prices 10% a year, year after year, and people still bought the candy. Excellent management under Chuck Huggins, who maintained quality and resisted reckless expansion. A very understandable business model. Making and selling candy isn't rocket science.
And they paid up for it.
Right. They invested in quality at a fair price. Paying 3 times book value seems steep then. But Munger convinced Buffett it was rational for such a durable, wonderful business system. And then, critically, the patience filter. They held it for decades, letting that value and compounding work its magic within the system.
And the intellectual latticework, psychology, understanding brands.
Clearly, understanding consumer habits, brand loyalty, that's applied psychology, going way beyond a spreadsheet. And the temperament engine was definitely running. It took conviction to pay that premium and incredible patience to reap the rewards over 50 years.
So C's really proved the concept. Paying for quality, then waiting.
Yeah.
It worked. And that shaped later huge wins, like Coca-Cola.
Absolutely. But as you said, no system gets everything right. The sources also dig into the anti-portfolio, the big tech names they famously missed, like Google and Amazon in the early days.
Right. If the system is so good, why did it whiff on some of the biggest value creators ever?
The main reason given comes right back to those filters specifically. The circle of competence. They were very open about it. They just didn't feel they understood these new kinds of tech businesses well enough to value them reliably using their existing framework.
Buffett said he didn't know how to value them.
And Munger admitted they felt at a big disadvantage trying to analyze high tech.
Okay, so the very strength of the circle filter, avoiding mistakes, also acted as a constraint, a limitation.
It absolutely can be. Sticking rigidly to what you know can lead to huge errors of omission when entirely new ways of creating value emerge outside your expertise. It also showed the limits of their traditional framework in valuing intangible assets.
Like network effects, brand in a digital age.
Exactly. Or just forecasting hypergrowth way out into the future. These are often complex, emergent properties of new tech ecosystems that didn't fit neatly into their models focused on tangible assets, predictable cash flows, and established moats.
And Munger wasn't a fan of rapid change.
No. He famously said something like, "Technology is based on change, and change is really the enemy for someone seeking predictable long-term investments." His system was optimized for finding stable, durable structures within the wider system. Tech disruption with its rapid obsolescence cycles, that competitive destruction happening super fast, can vaporize traditional moats quicker than the framework was really designed to handle.
So you've got this inherent tension, the value of sticking to what, intellectual humility versus the need to keep learning and potentially expand that circle as the world, the system, changes around you.
That's the crux of it. And they knew it. They basically said younger investors today have to be competent in tech. But for them, given their age and the sheer scale of Berkshire, pivoting into rapidly evolving fields where they lacked that deep intuitive grasp was just too difficult, too risky under their own rules.
Although that later investment in BYD, the Chinese EV and battery maker, which is definitely tech heavy, that was often linked to insights from Li Lu, their partner.
That's a really interesting point. It might suggest some evolution or maybe a willingness to operate outside their direct circle by relying heavily on trusted experts who do understand those complex new systems. An adaptation, perhaps.
Okay, so let's really push on the limits now. If the system has these strengths, but also these potential blind spots, where is it most likely to break down or underperform? Let's do a quick red team challenge. Where is it brittle?
Okay, good question. You have to think. When would this way of thinking struggle to make sense of the market system? Well, one clear area is during long, rip-roaring momentum markets or speculative bubbles.
Because they refuse to overpay.
Right. Their discipline, their focus on intrinsic value and durable moats, means they'd likely sit out rallies driven purely by hype and sentiment. They'd lag badly because the signal their system is designed to detect fundamental value gets drowned out by the noise and irrationality in the wider market system.
And during those big new economy shifts, like the tech revolution we just talked about.
If the key innovations fall way outside their circle of competence, and they don't adapt or expand that circle fast enough, the system will miss major wealth creation. Its filters just aren't designed to evaluate disruptive technologies that might make existing moats irrelevant overnight.
What about weaknesses within the philosophy itself? Points of brittleness?
The circle of competence rigidity is a big one we keep coming back to. How do you really know where the edge is? How do you avoid it becoming a blind spot that prevents learning? That's tough. Then there's the sheer scale issue for Berkshire. Now the universe of potential investments big enough to matter is small, and those giants might be harder to understand or offer less growth.
And their preference for simpler businesses.
It's often a strength, avoiding unnecessary complexity, but it could lead them to systematically ignore potentially great opportunities in complex but vital fields, like advanced biotech or AI, just because they're hard to model with the certainty the system demands. And there's always the risk of value traps.
Paying a fair price for something that turns out not to be quality.
Exactly. The whole wonderful company at a fair price thing hinges on correctly assessing the quality and durability of the moat going forward. But moats can erode, especially with technological change. Is a brand moat today as strong as a data network effect moat? The system has to be applied adaptively.
So it seems the system's greatest strengths, its conservatism, its focus on understandable quality, staying disciplined, can become weaknesses during periods driven by forces outside its comfort zone, like massive disruption or pure speculation. Its own immune system against folly can sometimes reject transformative opportunities if the learning part doesn't keep up with the changing external system.
That's a very good summary of the core tension. It's an incredibly powerful framework, but it's not infallible. A lot of his power actually comes from recognizing its own limitations.
Okay, let's make this really concrete. We talked about past misses. Let's try to simulate how this Munger operating system, as we've described it, would tackle a modern, complex business right now. How would he analyze, say, Snowflake, the cloud data warehousing company?
Okay, Snowflake. Applying the Munger system today, step one, absolutely foundational, would be understandability. He would exert just immense effort trying to really grasp what cloud data warehousing is, how does it work, what problem does it solve for customers, how does multi-cloud function, who are the competitors, Redshift, BigQuery, Synapse. He'd be asking why, relentlessly.
Until he felt he truly got it.
Or until he concluded he couldn't get it to his satisfaction. And if he hit that wall, the process stops. Outside the circle, no investment, period. But let's imagine, for the sake of argument, he puts in the work, maybe leans on expert input like with BYD, and feels he can understand the core business system.
Then he did the moat question hard.
Absolutely. Dissecting that economic moat. Is it genuinely durable? Is it just a current tech advantage? Or are there real switching costs, network effects, maybe a data moat? He'd be inherently skeptical of purely technological moats, knowing how fast things change. He'd probe for deep entrenchment in customer workflows. How vulnerable is it to the big cloud players like Amazon, Google, Microsoft?
Management quality next.
Critical, especially in high-growth tech. Who's running the show? What's their track record? How are they allocating the huge amounts of capital needed for growth? Is their focus long-term value creation or short-term metrics? And fundamentally, are they trustworthy? High growth brings unique challenges in culture and capital allocation that would get intense scrutiny.
And then the elephant in the room for a company like Snowflake. Financials and valuation.
Yeah, this is where the Munger framework would really grapple with a company like Snowflake. He wouldn't just accept reported earnings. He'd dig into the quality of the revenue, looking hard at things like ARR, customer retention rates, net dollar retention. These show the health of the underlying business system.
And stock-based comp.
He famously called it bullshit earnings. He'd be extremely wary of how much it masks the true cost of doing business. Ultimately, he'd need to see a clear, believable path to substantial, sustainable free cash flow, because cash is what ultimately matters, not just revenue growth.
And the valuation. Snowflake often trades at very high multiples of revenue.
Right. So the framework would demand a super rigorous analysis, probably some form of discounted cash flow model, even if back of the envelope, focused squarely on projecting future free cash flows, not just revenue or fuzzy EBITDA numbers. And critically, it would demand a massive margin of safety.
A big discount to his estimated value.
Huge. Precisely because the future is uncertain, the tech landscape changes fast, and the complexity is high. The risk is higher, so the required margin of safety has to be wider. He'd be asking, is this truly wonderful at a fair price, or is it just pretty good at a speculative price driven by market enthusiasm?
And he'd definitely bring in psychology and inversion.
Oh, constantly. He'd be thinking about the biases swirling around hot tech stocks. The glamour, the FOMO, the tendency to just draw a straight line up for growth forever without considering competition or saturation. And inversion would be key. How could Snowflake fail? What are the specific ways we lose money here? Is it disruption? A price war? Can they actually monetize effectively long term? Key people leaving. He'd obsess over the failure modes.
And if, hypothetically, he did invest after all that?
It would only be with the intention of extreme patience, holding for the very long term, assuming the business system stayed intact. And he'd be looking very skeptically at the intangible assets, trying to separate genuine platform value and network effects from just market hype.
So, putting it all together, based on this operating system, an investment in Snowflake seems possible in theory, but the hurdles are incredibly high. You'd need overwhelming conviction on the moat's durability, a clear sightline to real cash flow, and a very large margin of safety.
Extremely high hurdles, yes. Given Munger's known preference for predictability and simpler businesses, and the inherent complexity and high valuation of many leading tech firms today, the default application of his framework would likely lean towards caution, towards non-investment. Unless there was that extraordinary conviction, perhaps aided by deep expert insight like the BYD example suggests is possible.
Okay, let's try to synthesize this. We've taken apart Munger's operating system, the systems-based worldview, the rigorous filters, the Latticework fuel, how it builds temperament where its limits might be. It's clearly coherent, incredibly powerful for preserving value and avoiding big mistakes. Its limitations seem to stem from potential rigidity, especially around that circle of competence, and adapting to very rapid systemic change, particularly in technology.
And importantly, its power also comes from that built-in humility, that awareness of its own boundaries.
Right. So if you had to boil it all down,
Yeah.
if someone listening could only take away one core concept, one lesson from Charlie Munger's whole approach, what would be the single most powerful lever?
Wow, just one.
Okay.
If I have to pick the master lever, the single most impactful idea to integrate from Munger, it has to be the relentless, lifelong cultivation of worldly wisdom through building and actively using a multidisciplinary latticework of mental models.
Why that specifically? Above the worldview, the filters, temperament. Why is the latticework key?
Because it's the fundamental engine for understanding the complex adaptive system itself, not just in markets, but in everything. It transcends finance. By deliberately pulling in big ideas from psychology, history, biology, physics, philosophy, engineering, all of them, you build a far more robust, adaptable framework for making sense of the world.
It gives you those multiple lenses we talked about.
Exactly. It builds your defenses against error and folly because you see forces and connections others miss. It massively enhances pattern recognition. It helps you anticipate those second and third order effects rippling through the system. Crucially, it fosters intellectual humility and drives continuous learning, which makes you more adaptable. It leads to more rational, less error-prone decisions across the board, not just in picking stocks.
So it's not really about learning specific investment tricks or models.
Right.
It's about fundamentally upgrading your entire thinking process.
That's it, precisely. The latticework isn't just another tool, it's the meta skill. It is the operating system upgrade. It improves how you approach every complex decision because it gives you a richer, more accurate map of the complex reality you're navigating. It's about learning how to think more effectively, not just what to think about a specific investment.
A really profound concept. And looking at Munger's life and success, it clearly demonstrates the power of that approach. It's far more than just an investment strategy. It's a prescription for clearer thinking in a complex world. It certainly challenges you to think broader, deeper, and hopefully more rationally.
It really does. It demands that you keep learning, keep connecting ideas from different domains. It's a lifelong project.
So let's leave you, the listener, with a thought based on that core idea. The latticework is your personal operating system upgrade for navigating complexity. Reflecting on the power of drawing from diverse fields, what is one discipline completely outside your usual comfort zone or core focus that you can start exploring, even just a little bit starting today, to deliberately upgrade your own thinking process.